The consumer is reacting violently to this loss of purchasing power. So I don't think it's going to feed inflation. I think it's going to feed this negative sentiment that the consumer has been feeling. On the innovation front and on market indicators, cryptocurrencies, Bitcoin, Ether, they have corrected with the equity markets. More and more hedge funds are involved in them. So when the market corrects, we do see higher correlations these days. I know that this fear that inflation at 7%, which is the CPI right now on a year-over-year basis, is getting embedded into the system because wages are rising and so forth. So what we're seeing on the monetary and fiscal front right now is effectively significant tightening already. On the monetary front, we've seen money growth go from 27% at its peak during the coronavirus, the depths of the coronavirus, to 13% recently. But if you look at it a little more closely and in a shorter term time horizon, we're down to 8% growth on a 3-month basis, 6.5% on a 2-month basis. And we believe that money growth will continue to slow quite significantly, especially if the Fed does raise interest rates. Although over a full market cycle, the correlation between crypto assets and any other asset is extremely low, which means for diversification purposes, crypto is a very interesting asset. In our Big Ideas 2022, you will see how we break out crypto. Our understanding is evolving, and we are able to describe it in 3 ways: a money revolution, a financial revolution, and a next generation internet or metaverse revolution. So if that piques your interest, do take a look at our Big Ideas 2022. I'm very proud of our research. Our research is unlike anything else you'll see out there. You will see ours because we give it away. Again, unlike most other firms, meaning we give it all away. The ratio of new lows to new highs was as high as it's been since 1999. And in 1999, it was the value stocks that were hitting new lows as everyone was racing into the internet. In this last year, it has been our kinds of stocks that were hitting new lows as value stocks were hitting all-time highs. And as you know, the right thing to have done during the late 90s, when that ratio behaved that way, was to move away from the new highs into the new lows. And I think the same is true today. And I'll just give you a sneak preview of what may happen here. You know, I was very interested after Ford said that the demand for its F-150 Lightning EV was so much stronger than it expected, its stock exploded. Now, I want our auto manufacturers to be very successful in the EV space. But to see its stock jump to highs that it had not seen since 2000 is a sense of what I just said. What that move said to me is, oh my goodness, investors don't understand that 97 to 98% of its sales base is gas-powered cars, and we believe that the shift toward electric is accelerating here. Oil prices being one reason, but also lower prices being another as battery costs come down. So I found that very interesting in the context of the juxtaposition of the late 90s against today. We're also seeing a lot of confusion in the more mature growth area of innovation. Facebook is facing real competition, and TikTok is of course the reason, and it's also under pressure because Apple is not giving it or allowing it to have as much information about users, and has put in place new privacy objectives and rules.